Alfonso's here, the godfather of the game. Many years of wisdom, remember his name. Speakers on stage, they'll drop the keys. Unlock your power and seize the breeze.
And I've heard your name a lot, seen your face quite a bit over the years, but we've never actually crossed paths directly. So thanks for making the trip down.
Hey, Andrew, good to be here. You know, it's like I seen your face too. I'm like, why don't I know this guy more?
Yeah. Well, you're here now. I think Peter Klosko had set this up.
Yes.
And he mentioned that you should be on the show. So if you wouldn't mind, give me the high level view of what you do. I know you're a real estate investor, but tell me the story.
Yeah. So look, I'm a multifamily investor. Primarily, I've done everything in the game. 23 years in the game. Okay. So just like a lot of investors, we've done the SDUs, the RTOs, the flips. But what I really enjoy is multifamily apartment buildings. So over the past 23 years, I've been able to build a portfolio across Canada of 600 doors. Okay. And now we're actually set up to grow and scale in a very big way. We're investing not just in Canada, but we're also in the US as well.
Yeah. What areas in the US are you in?
So we're looking at Arizona. We have something actually, I'm so surprised. We found something in Los Angeles, right?
Wow. Wouldn't expect that.
Well, no one expects it, but we have something really nice there, 18 unit apartment building. We're paying premium price, but those are the markets, as you know, it's 10 times bigger than Canada. But it's not like I'm saying goodbye to Canada. Mm-hmm. I'm just erasing that border, that line for people, right?
I'm big on the U.S. right now. I think that it's a great opportunity to diversify, especially a political hedge. You have another whole country that you can be invested in, and
Do you invest in the U.S.?
Yeah, I've got some U.S. investments, and working on the investor visa as well, and just kind of it creates some options and some flexibility. If I want to shift gears and move down there, I can.
Yeah, well, you know what? Like people, they, especially us in Ontario, we look, New Brunswick, we go Timbuktu, Saskatchewan, we're going to Timbuktu, Alberta. But there's also this whole other market south of us that no one's really exploring, right? And, that's exciting. It's a market that's 10 times the size of Canada. You have more inventory. And, depending when you go. So we're looking at Arizona, we're looking at Tennessee. I would have loved to been in Texas or Florida, but it looks like we're priced out right now. But
for multifamily,
things are shifting.
There's not as much multifamily in Florida, like Tampa, yes, Miami, yes, not south of that in terms of like the Gulf Coast,
or the big So we're looking for big portfolios, like
you just want to buy up,
like 300 units. That's kind of the things that we're looking at.
Okay. Yeah. And are you syndicating these, or like how are you structuring them?
Yeah, all of the above, right? So sometimes they're partnerships. Sometimes, when I was starting out in the industry, I was doing a lot of joint ventures. But now we're moving into GPLP structures, syndications.
And how do you go about raising money for those type of things? Obviously, there's a lot of securities challenges with that. Are you getting like an exempt market offering, or are you?
No. Basically, you get that you have the Securities Commission. They're there. They actually have a purpose. And most people tend to be afraid. And there's a governing body that governs trading of securities, and I think they should be. Because there's a lot of cowboys.
Sure.
Right? But at the end of the day, you follow the rules. For us, we just work with accredited investors, friends and family kind of thing. And that's about it. And so we don't look for investors. We don't look for investors. We attract investors.
Yeah, so they're kind of finding you. And I'm imagining you have like a private list that these people are on.
Yeah, exactly.
Yeah,
exactly. And it's going to take time to build that. A lot of people want to go to that.
Yeah.
I go and I teach a lot in a lot of the trainings that I do, going from a regular investor to the investor. And when you become you enter the category of one.
Right.
Once you enter the category of one, when you're the Andrew Hines, you're not just Andrew Hines, you're the Andrew Hines.
Why I picked that handle.
Well, you enter the category of one. people are coming to you, right? And when you're a realtor, a mortgage broker, a plumber, you will always have to beg for the business.
Right.
When you become this is when people come to you, and then everything opens up.
So how would you structure one of these deals? Have you already like closed on one for the States? Or
Yeah. So just GPLP, right?
Okay.
Right now in the U.S., the challenge is there's a lot of people, trying to preserve their capital.
Like saving it for when things come down.
Well, we have inflation.
Yeah.
Right? We have the inflation factor.
Yeah.
Stock market's in the toilet. Crypto's in the toilet.
Mm-hmm.
And so people are running for real estate. And so you got to be competitive. And so, what we're structuring now is a situation where we can go in and buy these properties cash.
Okay.
Yeah.
So you've got basically the funds on hand ready to go.
Yeah. But that's one of the strategies, right?
Mm-hmm. Through the GPLP strategy?
Yeah, through the GPLP structure.
Okay, so you're going in cash, you can obviously refinance the money back out after you close.
Exactly. But then you have more time, right?
Yeah.
What happened, everyone's in such a rush, especially when you're living, like we're living through inflationary times right now.
Yeah.
And the name of the game is capital preservation, right?
Yeah.
If the money's sitting around, you're losing. I mean, the government said, 8%?
Yeah.
I call BS.
Of course.
Do you believe it's 8%?
More like 20.
More like 20, yeah.
Yeah.
It feels like 50, but more like 20.
I was saying 20 back when it was still like a debatable topic, and now you look at the key things you buy. I mean, they're
everything's
pretty well,
doubled.
Yeah,
Right?
like
Gas.
gas is doubled alone, and that's a huge expense for a lot of people. Rents are up. I mean, of course, if real estate was in the basket of goods, like that would have, it's what's not in the basket of goods for the consumer price index that skews the result. So the mandate of the government will be to control the inflation that they admit to. So we just have to keep that in mind.
Well, then when people see the interest rates going up, I think July 13th is
the next one,
Judgment Day. I'm not sure if this is going to be airing before that or
this will be after that. So we'll know that.
So actually, no, it just happened.
Yeah, it just happened. Yeah.
July 13th just happened, and they went up 0.775 basis points, and and there's a lot of opportunity. I see opportunity when these things happen.
100%. Like there's you'll hear the stories like more millionaires created in these times than any other, and it's about being positioned to take advantage. And I think it's a great time to have a fund or a private community of investors that are poised and ready to take advantage of opportunities when they come.
The next 5 years, Andrew, will be shown like in history. When we look back in history, and they're going to be liquidating 10 cents on a dollar, mixed with a recession and people in scarcity. There's going to be a massive wealth transfer about to happen in the next 5 years. And by the way, no one has a crystal ball, so this is just my opinion.
Yeah.
I think it's going to be this up and down lever for a while, where they're just like, we're in the recession now. Let's reduce interest rates.
Yeah.
And then it's like, oh no, now we're back. So I think it's going to be like an up and down more than what we've seen, where it's like we've seen inflation rate consistent for like over 20 years at 3%.
Yeah, again, that they admitted to.
Exactly.
I don't really believe we ever had real economic growth after 2008. I think because the inflation adjusted rate would have shown that it wasn't actually real economic growth. They
printed money again.
They printed money back in 2008, and it took a while for the full impacts to be felt of what happened then. And now, of course, even more so. But I think that the competing forces, again, they're going to make it really tough to know where things shake out. Because traditionally, we have what you would call stagflation, right? It's undebatable. You could deduce that we're going to be in a recession once we have the two quarters of negative growth. Mm-hmm. So normally what they would want to do is lower interest rates to get things going. But when you have a recession paired with inflation, that's stagflation. And now, yes, like you said, lever on, lever off. What do we do?
Yeah. Well, the thing is, the answer for the longest time has been kick the can down the road.
Yes, until you can't.
Yeah. Well, I mean, at some point, it's like a Ponzi scheme. It's like at some point, the jig is up.
Well, and that's the big thing. Like people have been talking about the quantitative easing, and it's just sheer market manipulation, like buying bonds, selling bonds, manipulating the price at a government level. rather than letting the free market shake out. Because if they were to let the free market shake out, then that might prevent a certain politician from getting reelected. That's why they want to kick it down, right?
They're just like, okay, let's just like stabilize it, keep it moving, print money, print more money, print more money.
Don't want it happening on our watch.
Someone will pay in the future. It won't be us.
I heard a quote, or I read a quote the other day, like a politician's first job is to get elected, their second job is to get reelected. And everything else, their job comes far behind those two.
Well, you know what? At the end of the day, and as you know, we're professionals. We're professional real estate investors. So very much like the NHL, every year they change the rules, right? And professional hockey players show up and play the game within the new rules. The same wind blows on us all.
We got to do it all. I mean, there's never an excuse. Like you can look at the macro and say, oh, well, that's hard, or it's, it's going to hurt so many people. And yes, that can be true. But at the micro level, we're all in control of our actions, and we can all create our own.
And there's
future.
always opportunity everywhere,
in every circumstance.
We're buying we're buying during recoveries, expansions, or stabilizing declines. We're buying, like we're investors.
So
like,
are
you an investor, or are you like a flipper, right? Like, are you if the only way you're going to make money in real estate is if that piece of real estate is going to go up in value, you're not truly an investor. You're you're a speculator.
Speculator, absolutely. Yeah, and that's the on the Bitcoin side of things, why I always had trouble with that, because you have to be kind of banking on the value of it going up. With real estate,
and it doesn't have income.
It doesn't have income, right? With real estate, you got the income, right? I mean, so there's a lot of people who made a ton of money in, like, say, Bitcoin, but you had to speculate on what other people thought it was worth, and how many other people were going to go buy it to drive your price up.
And you know what? Like, we're still in the best country in the world. I grew up in Latin America, in war-torn El Salvador, and then we had to move to another country, and communist country, Nicaragua. And at one point, you couldn't even buy food, right? And there is no opportunity, zero, right? And so, when you come here, you see all of the opportunities around you, and like a lot of people just, they just go. They take it for granted.
That's true. Yeah. There's still so many ways to be successful here in Canada.
The banking system. It's beautiful. They lend you money on real estate.
That is nice. The leverage, right? Like,
they're not going to be lending you money to buy crypto.
No. I think that the biggest thing with real estate, that was one of the most attractive features, is that you can leverage it at 80%, 75%.
The government, that means that the banking system, they're telling you how much
confident
faith
they are,
and how confident they have over real estate versus
over everything else.
Because
they don't treat stocks the same way. They will still lend on stocks, but only in certain circumstances, not nearly as commonly.
You can short a stock or whatnot.
Or infinite banking, you can borrow against your.
Different
concepts.
Different concepts. But at the end of the day, real estate it's true. It's been proven. And for me, especially, in the multifamily space, in the apartment building space, what really attracted me, Andrew, was the economy of scale. This idea that people will always have to live somewhere as long as you have, like, we focus more on affordable living, not low income, but like, in the middle, right? And what happened was, some of the decisions that we've made, we've always made them with that in mind, that Armageddon-proof type business, And so we have doors all across Canada. And when 2020 came, right, everyone was scared. March 2020, April 1st, Andrew, was Judgment Day for all investors. If you remember, it was
people were scared.
We didn't know if people were going to pay their rent.
That was.
But if you remember, the government gave them just enough to, pay their lodging, buy their food. The government didn't pay, people to live in their luxury condo downtown Toronto. You know what I mean? At $3,500 or $4,500 a month. They gave you $2,400 a month and make do. And so what happened? Well, by the time April 1st came, and of course we took massive action at that time, we were 98% collected. Right. And then I have people in the space, good friends of mine, with luxury properties, shiny stuff, beautiful stuff. When you look at this stuff, it's like gorgeous. But they all suffered during those times. They did well during the good times, but during the bad times, people are not looking for luxury. right? They're not looking for those extras. They're
Yeah.
looking for just basic. I want to live here. This is my rent, and we were able to come out of it really
Yeah.
in a positive way.
No, that's great to hear, and I agree with you on finding stuff that's recession proof. I'm always thinking that. People would ask me like, "What do we do?" Like knowing what's coming, because I was kind of calling this out and predicting this back, year ago, especially the inflationary problem. What do I invest in? What will people always need? That's
Housing.
the question to ask.
They will always need to live somewhere.
Yeah, somewhere. They'll always need food. They'll always need.
Look at the grocery stores.
Energy.
They made a killing.
Yeah, grocery stores do well. Yeah, so I mean, if you're thinking about things like that, I mean, like sure, for currency, like gold and silver can be nice, but I mean, if you're hungry, you need a sandwich, not a piece of gold or silver, right? So,
and also it costs money to store.
Yeah.
Right. So the storing fees of gold and silver.
Yeah.
Sometimes when I think about it, like this, not only does it not provide income,
Yeah.
it's just a place to hold
It's
the
just
wealth.
insurance.
Yeah,
and
yeah.
it's an expensive insurance in a way because, like you said, you got to store it. You got to worry about where you're going to put that. Of course, I do like it. I think it's got its place, but it is, it is a challenge.
This is what I know. The economy of scale of an apartment building, all the different profit centers in real estate, at the end of the day, I can't picture myself, getting into any other asset class other than where I'm at right now,
Oh yeah, for sure. And I want to run through like kind of an example of what you look for. What maybe we take a recent one that you've bought and kind of work through the numbers on that.
My strategy has changed over the past 23 years. So when I started, I was a value add guy.
Okay.
I was like, go in there, roll up my sleeves and turn a property around and just be really, really aggressive, right? 23 years in the game, I've been able to create a really solid portfolio where I was able to take 20% of my portfolio and sell it off in the height of all heights, which has been the past, year, and created a liquidity event. So now I'm moving more towards newer, cleaner, lean and clean, right? Brand new assets, developments, building. And so that's kind of the space that I'm playing in right now. Right here in Ontario, especially with the rent control, there's incentives for new builds. For example, they don't follow the same rent control
absolutely.
rules.
Yeah.
So they're kind of inflation proof in a way, because if you get hit with inflation where rents are going up, you kind of have that flexibility. Now you are paying a premium, right? You're going to pay a premium. So like, for example, one deal that I just did, which is a 16 unit apartment building at 4.65, right? So we're paying a premium per door, when my average per door historically in my portfolio is about $100,000 a door. Yeah. Right. So I was looking. So back in 2016, 2017, I was going in secondary markets paying like $60,000 to $70,000 a door, and that was kind of my MO. Adding value to the property. In this case, 16. What's the cost per door? We're like close to 3, right? So
somewhere in that ballpark.
4.65 million, 16 units, brand new. You got an elevator.
You'll just keep the whole building.
Yeah, it's beautiful. It's clean. Yeah. It's got a parkade. This one I'm doing now, 60 units, 14.5 million, right?
New builds.
New builds.
And are you buying at like land entitlement stage? Or
so I'm directly from the builder. So I'm doing both.
Oh, so you're having a builder just build it out.
Right. So right now I have one in a major market that I'm doing a 30 unit.
Yeah.
That we're building. Right. Yeah. So I'm involved with the building. Now I'm not a builder. I partnered up with the builder to go. We went through the bringing that lot to site plan approval. Yeah. 30 units, parkade. In a major market after we're done. So with soft costs, value of the land, construction costs, we're into it for about 10.4 million. And then we'll get a after construction value of about 14 and change. And so we'll be able to refi that building and pull out 80% of the.
How many units will that be?
30.
30. Okay.
Yeah. So then we're doing so that was that was after actually buying a few from the builder.
Yeah.
Why I like that? I know I'm paying a premium.
Yeah.
But it's for me, it's the least complicated. It's a path of least resistance, because I have my set price.
Mm-hmm.
The builder has to actually fill the units for me, so they have to lease it up and they have to lease it up at the number that we've talked about to get the value that we've talked about.
Well, at 30 units at 14 million is 466,000. So these must be some nice units.
Oh yeah, those one that one is. But the 60 units at 14.5, what is 230 something a door?
So you said the 60 at
60 at 14.5 million.
Okay, yeah, then you'd be closer to that. Yeah, 60 at 14.
I think it's about 233 a door or something.
241, yeah.
241 a door. Yeah. So there is a benefit to new.
Mm-hmm.
In 20 years from now, it will still be new.
Yeah.
My insurance loves it.
Yeah.
Right? Because right now, with the replacement cost of buildings, insurance companies are scared. Right? They're scared to insure something that it was built in the 1940s or 1950s. That's where I used to play. That's where I started. Buying properties that were built in the 60s, 70s, and where I could see the opportunity. And now we're into like brand new. In 20 years from now, it's going to be new. For the first year, it comes with fully warranty. Everything comes. The roof has a warranty. The windows have warranties. The appliances have warranties. It's just like this beautiful honeymoon phase that I'm enjoying right now. And the investors love it. It's brand new. It's a shiny. It's like
nice.
It's a shiny thing that they could it's bragging rights.
And where, with these type of properties, are you expecting to cash flow right off the bat? So the value adds, which I still do the occasional value add, right? So I'm not completely away, but I'm not going to go into like something that's so intensive, right? Where you got to like really turn around all of the units or whatever. So you might just turn them around.
I'm an
as
old
they
man,
vacate.
Andrew. I'm 45.
That's still young.
I paid my dues. I've been doing this for 23 years. I've been fighting with the crystal meth heads and the crack heads and and all of these people. Nothing wrong with those people. Nothing wrong with those people. But you know what? I paid my dues. Sword fights. All kind. If I shared all the stories with you. I got scars, Andrew. I got scars.
That's wild.
But now I'm going for lean and clean. And so, yes, you're right. We are in Calgary. Yeah! And we are about to make history because for the very first time in Wealth Genius history, we are bringing the Expand Investor Conference right here to Calgary. And we're excited. November 6th, 7th, and 8th. Get your tickets right away because we're going to have over 60 different presenters, over 100 different vendors, over 1,000 different attendees, all at Expand Investor Conference right here in Calgary. There's never been a better time to get involved in real estate than right now. You got to come and learn how to optimize and maximize all the opportunities that are available right now. It's our 10th edition of this massive real estate investor conference, one of the biggest in Canada, and we're making history because we're bringing it to Calgary for the very first time. Get your tickets, be there or be square. Little light on the cash flow, right?
Yeah.
But you know what? I'm looking for a different type of clientele. All the people that are investing in a lot of my deals, they're accredited investors. Mm-hmm. They understand the stock market. It's what it is.
Yeah,
you know what I mean. And it's good and it's not good. Like, how do you even sleep at night? We're living through a time where someone with a tweet can impact that line. So a lot of the people they're done with that. They're done with crypto, and they're looking for capital preservation, right?
Yeah.
Get into a good asset that is going to
on.
perform. And if our cash on cash is like 3%, a true 3%. So we're not like playing with numbers here, like this is like 3 or 4% cash on cash, better than losing 16% or 20% if the money's sitting in the bank account. And so that's kind of a bit of the shift that I've made in my career versus all the value add stuff that I was doing before.
Yeah, it's a little bit more hands off too. If you can just partner with a builder, is the builder an equity partner?
Well, in one of my the one that I'm doing from we're going through the whole process. That builder is an equity partner. Everything else I'm buying directly from the builder.
From them, yeah.
Yeah, so I have a 24 unit coming up. I have a 44 unit brand new coming up.
How do you just have a builder that has that, or are these developers that were developing it anyway and you're just taking the whole thing?
Yeah, they're I love to make connections, relationships, connect with people that are in the space, that are doing real estate, they're building, and people say, well, why would builders sell this? Well, they're builders. They're not investors, right? They want to get in, get out, go to the next thing. Get in, get out, go to the next thing. And there's obviously incentives that were created in the past 4 years in Ontario that allow builders to make money building apartment buildings versus before. The reason why we're in this situation in the first place is because there was no incentives for people to build. So that's all they did is build condos.
Right.
Once the government puts it in the hands of the entrepreneurs,
they
will solve this vacancy
way,
crisis, right? Yeah, make it so we can make money, right?
Right. Yeah.
Give the incentives. You'll see if you give enough incentives, people will build. You'll see, you'll see, and then you'll create jobs. I mean, there's benefit.
What are some of the incentives that you like right now?
Tax incentives.
Okay.
So you can apply for a tax. I'm trying to remember the name of it. I know it's not going to hit me right now, but for example, we're in this secondary market, and for the first year we have tax break. Right, so property tax break.
I've heard of this. Welland does something like that as well.
Yeah. So we have a property tax break. So the first year, I think it's there is no tax. There's no property tax. The second year, and I have to check with my admin how exactly it works. But those tax, I mean, the one thing that really takes the cash flow out of a deal is the taxes. And so
just get rid of those.
Yeah, just get rid of them, or make it so it's not as harsh, so people can build. And so there's tax incentives, the rent control. That in itself is the reason why you want to go into new builds.
Yeah. Then you can just set the price to whatever you want. It used to be 1993, and then wasn't it Doug Ford, or it was right before Doug Ford took office in Ontario that it got updated to 2018, I believe.
I'm not sure if it was Doug. I think Doug.
It was right before Doug, but he didn't undo it.
Okay, good.
That's my understanding of it.
Yeah, I'm not a political guy, so I don't believe in one party. I believe in efficiency.
Yeah.
So make it easy for me to make money, and we will help the economy. We will create jobs, and we will build. We won't have a vacancy crisis.
No, absolutely. If the government just got out of the way, all these problems would be wrong or gone. We would be in a good spot. But,
it's been proven.
Yeah. Let the free market.
Yeah.
Because people who have an entrepreneurial mindset, and if they're taught that, you go out and you solve people's problems. Yeah. That's what an entrepreneur does. Yeah. Go solve people's problems and you make money for doing it.
Rent control, it's actually hurting the people that you're trying to protect.
Absolutely, right? It does, because now the landlord needs to charge more to all the other tenants to make up for the fact that he's making less off of the ones that are staying and won't leave.
Also, with the landlord-tenant rules, you're trying to protect tenants. You're actually hurting them, in my opinion, right?
I agree with you.
I'm just a investor here, but there's some people that you're like, you know what? I would love to take a chance on this person. I know the credit wasn't right. Something happened in their life.
Yeah.
And I would love to take a chance. but I
I
can't.
can't risk it. Can't risk putting them in my unit because once they're in, I can't get rid of them.
That's it.
Exactly. And
The risk is too high, Andrew.
Yeah.
And so what am I going to do? Right? The only thing I can do is like, okay, I'm sorry. I wish. And so what happens is a lot of these people are not going to get places anywhere. And this is where you have tent cities. We live in Canada, the most prosperous country in the world, one of them. And we have tent cities. When we have all of this land, it doesn't make sense. And so, and I know where the heart is. You know, they want to protect tenants.
Yeah.
And I'm not a politician, so I'm sure that I'm only speaking from one aspect. But maybe there's other aspects that I'm not looking into.
Yeah, getting elected and getting reelected. Those are the other aspects.
Exactly. So those kind of things that in the market that that led me to new.
Yeah.
I love new, and I'm in a position now that I've been doing this for 23 years. I've built a reputation. I've proven myself. And I've paid my dues.
Yeah. So with these ones here, same type of thing, GP-LP structure or syndication?
Sometimes they're just simple partnerships, right? Sometimes they just, get a few of our, some of these deals are not that much. They're not that capital intensive.
Yeah.
But the bigger stuff, yes. If I'm looking at 100 unit, if I'm looking to take something down that's serious, or we're doing stuff in the US, GP-LP, for sure.
Yeah. Now with the US stuff, if you're doing those, I've heard people say it's not, Quentin D'Souza came on and he said, it's not as profitable for me to do it in the States. He's like, because up here in Canada, I could do 50-50 with no money in all the time. Whereas down there, it's harder to do that. Has that been your experience?
I would have to agree, right? But the thing is, I'm not looking for US investors. All my investors are Canadian. So that it still works. And then the other thing is, Canadian investors there's such lack in inventory in Canada that they're looking for other options.
Yeah. How can I get this money performing better?
Yeah.
And what do you find that, like, what's the carrot that you need to dangle that makes sense? I mean, if whatever you feel comfortable sharing.
You know what? Everyone has different reasons. We are living through different times. So it's really what's happening in the market, Before, and people are like, what about your value add stuff? People love my value add stuff, and it's not like it's going away. Right. It's just you're finding less and less of it, right? Yeah. And I had to retrain my investors. I'm like, guys, if you're just waiting for value add, we're not going to do deals, because it's not like I'm not going to jeopardize my 20 plus years in the game and investors' money just to get into something that may not make sense, right? Yeah. And so when I come with my numbers, when I show up, people are like, okay, they trust the numbers because they're all very conservative. And if I could do value add, we'll do it, right? Yeah. But it's not always the case. And so, I'll get people. Just the other day, someone was like, I'm not getting your emails anymore. I don't have anything for you. You wanted value add. I think we're going into a buy and hold stage where we just need to preserve the capital, and there's going to be opportunities for value add. Like, when the cap rates start going up, and you start to see a lot of these mom and pop operations, baby boomers. There's going to be a lot of inventory on the market. This will be a massive opportunity for the value add, right? And
that's actually something I really I'm planning on putting together, is like a list of people who want to take advantage of that. Like when this comes up, let's have our plan in place ahead of time.
Well, let's do it. Yeah, because let's call it the baby boomer trust. Yeah. Let's create a fund where we're just going out buying all baby boomers assets. And
it's happening. It's it's all over the place right now. People trying, just looking. They're like in their 80s now. They're like, and I'm done. Yeah. I don't need to keep this anymore.
And so those are opportunities, and they will come. Before, that's all there was. There was so many, like back in 2016, 2017. The value adds were there everywhere, right? And now they're there, but they're
overpriced
not
a lot of the time.
They're not. It's not like, oh my God, this is like a perfect burr, And so, that's what a lot of investors are looking for. But you have to think about one thing. The longer the money sits in your account or in other underperforming investments, the more you're losing every single time. And so, you know what? Look for someone that you can work with that is conservative, that sees the long term, that has a long-term goal, and stick with those people.
And what are your investors expecting? Like, are they expecting to be in for 10 years, 5 years? Like, what is the general idea? Or is it, we're buying it, we're keeping it?
So with the new stuff, it's plain and simple, like, we're keeping this.
So what if they wanted to sell their units or their shares in it?
Yeah, we have like, obviously, you know, if someone wants to, you know,
Exit.
Get bought out, there's no problem. We could do that.
You do like a current valuation?
Yeah. That's
how do you come up with a current valuation?
Appraisal.
Like, you'll just get an appraisal. Okay, so they just have to pay for the appraisal kind of thing.
We actually, you know, if someone really wants, like, if they're not in agreement with what the offer would be, you know, we'd get 2 appraisals and we'll get, like, you know, take the best of 2, you know, kind of thing.
And how many people, like, give me an example of where you might have like 3 to 5. Would you have 3 to 5 people in a deal, or would it be more like 10 to 50?
Yeah, it really depends. Like, there's some deals that it attracts, you know, people that are really, you know, accredited. They have have the capital, and I might be able to do it with like 4 people. Yeah, those are my favorite.
Yeah, right? it's less people to manage.
I want to work with like high net worth accredited investors that are looking to buy really amazing assets that are gonna outperform everything over time.
And those are also going to be the people who don't really care too much about the cash flow. So you have the opportunity.
Now there is cash flow,
right?
And it's going to improve over time.
Yeah.
But when you're getting into a new build, and this has been my experience, you know, you're into something where in 20 years from now, it will still be new. Right? Versus, you know, buying something in the 70s or 60s, which what I was doing before. But then the roof comes up.
Yeah, you still get your life cycle maintenance, but I guess you're saying your roof is still good after 20 years if it was done right.
Well, I mean, there's time, but if you're buying something that's in the 70s, you know,
you're probably on your 3rd round of life cycle maintenance with the elevators, with even more, 4th.
So that, you know, there's benefits, and you know, sometimes the projected cash flow on an older product ends up being the same lower cash flow because of all the maintenance that takes place.
Yeah, I always I'm a stickler on this podcast when we run numbers. I'm like, well, you're forgetting about life cycle maintenance. Oh, our maintenance is nothing. But like, let's picture, you know, roof comes up, there's 10 grand.
Yeah.
You know, I mean,
unexpected.
We got to amortize that.
Yeah,
we got to plan on that. The furnace goes, okay, where's your budget for that stuff?
Yeah, so what I love about the new, it's like the honeymoon. You get this honeymoon period.
You're not really needing to do any of that stuff for, I mean, you're going to start thinking life cycle maybe after 10 years for like minor stuff, and then the big items probably not for 25. So.
And so now the projected becomes more of a true cash flow.
Yeah, it's true. But like to my point, you know, these accredited high net worth investors, a lot of them don't really need that cash flow. They want to see their nest egg grow.
Yes.
I think the thing that you would probably want to avoid is cash calls.
And for sure. Yeah. Right. I mean, and then you with new, you're definitely avoiding that.
Yeah, there shouldn't be, right? Unless you know, there's an insurance thing, but I mean, then you call insurance. Yeah. Like those are your cash calls. Defects on build, you hopefully get at the warranty covering it.
And you know, I have a lot of videos. I do a lot of training on this with a lot of my students, where we talk about new builds. You have to vet the builder.
Yeah, because Terrion's not going to cover you with rental product, but the builder can still honor a warranty.
Yeah. And so you want to make sure that you know the builder, you've vetted what they've done, go and look at, you know, what they've built before. Fortunately, with this builder that I'm currently working with right now, I was able to see 4 other apartment buildings that were built that someone else bought, and I was able to walk through them, see how fast they were to act, you know, during like warranty calls, or you know, how fast did they react? Did they come to the property right away? Right. So I was able to do all my due diligence, and that's what I suggest. If someone's going to go down this road, make sure you vet the builder. Make sure it's not their first time kind of thing. which is nothing wrong. Maybe there's some good builder, but if there's their first time, like, okay, then we have to look at the property, get a property, do our proper inspections or whatnot.
Yeah, it definitely helps if you can see that track record and know that they have a reputation that they want to maintain. Yeah. And of course, you're getting into like larger stuff where I think that they'd probably want you as a repeat customer too.
Oh, for sure.
They know, hey, if I do a good job, you'll buy a couple more from me. That's repeat business.
Another thing that I love is that you get to see the whole process, right?
Yeah.
You get to see them pour the foundation. You get to see them, like you frame it. You get to see the inside. You get to see them. You get to see the whole process from scratch.
Yeah.
From like digging, right?
Yeah.
And so a lot of the deals that I have, I have them under contract before even the shovel hits the ground.
So you're just buying the land.
No, I'm basically, so there is times where I buy the land and we build, but the last couple of deals, the deals that I'm talking about, is me buying directly from a builder.
Yeah, well, / developer. So they've already got the land.
They did it all. They have it.
Yeah.
And they're like, I have this deal coming up.
Yeah.
These are going to be the numbers.
And
these are going to be the price. And I'm in.
Walk me through a deal like that. So say you might have 4 people that are going to invest in that deal. How would you structure it? At what point are you getting their initial investment?
So a lot of my deals, it depends on the deal structure. If I can make my life easier, I will take less equity. It might be like a 40-60 kind of thing.
So you'll take 40 potentially, 60% split among say 3 or 4 investors.
Yeah, exactly.
Yeah.
And there, you don't need to be greedy. You know what I mean? Like if your life is easier, if you don't have to go try to do a syndication, it makes things cleaner, easier.
Absolutely,
I do take an acquisition fee. Anywhere between 1 and 1.5%, depending on the deal. We're still going to do on a brand new build. We're still going to we'll still do an inspection. We're still going to do all our due diligence.
And are you paying, like, what kind of deposit structure you have once it gets rolling?
Yeah, so the deposit that I'm looking from the investors, you mean?
No, what do you have to give to the builder?
Okay, so I build a relationship, right?
Yeah.
So, before I was giving like $300,000-400,000, but now we're down to like $20K.
On a total value of what?
Of like, let's say 10 million, 14 million.
So 10 million, which you're not paying until it's done and ready to go?
Yeah.
With a 20K deposit?
Well, the thing is, there's trust. Right?
Yeah. So your developer's getting the financing. He shows the bank that he's got a purchaser.
Or the developers already has the money to build.
Yeah.
The developer's already raising the cap, doing his raise to build.
Oh yeah, they're probably raised bank construction financing.
Yeah, exactly.
Because they have a buyer, you. So they can finance it. They build the cost of that into the deal. You have a set price, like some of the examples you gave me.
Yeah.
Maybe even $460,000 at a door.
Yeah.
Which, I mean, if you compare to condo pricing, that's not that much.
No, not that.
Yeah.
Not that bad. At the end of the day, you have to do the math.
Yeah.
Right? You have to see where you're like. You gotta.
Yeah.
You gotta see where the costs are gonna be. Obviously you have your income. You have your expenses.
Yeah.
You're gonna have your debt service.
Yeah.
And then you have cash flow.
Yeah.
It either works or it doesn't.
Right, and you're going to make sure it works, obviously. Now, at what point are your investors contributing their first bit of money? Like because
I like speed. Like I'd rather have people set up right from the beginning.
Yeah.
I've been doing this for 23 years.
Mm-hmm.
This industry is small. I mean, we just met.
Yeah.
But we know each other.
Yeah.
Right? And like the second you mess around here in this industry, everyone will know about
people
it.
find out.
People will find out. And so I've been someone that I've always treated people with respect, and people know the types of deals that I bring to the table.
Yeah.
And I attract a certain type of investor that, when they're in. And so what we, if it's a simple deal, we could do a simple corporate structure, and if a lot of the times a lot of these people become friends, really good friends of mine. And so it's like, look, we're going to take this down. Kind of thing. There's other times where I may have to do a raise, and then I got to get my lawyer to create the GPLP.
Yeah.
We have a memorandum of understanding. We want to make sure that they're accredited. They come in on the LP side, then they sign a subscription agreement, and so many different ways that I'm doing things.
Yeah.
My favorite is just dealing with a couple people.
Yeah.
Hey guys, everyone's gonna kick in $500K, and let's just get this done.
Yeah. So in that regard, though, so you're talking to a developer builder who's going to sell you a product. It's going to take him 1 to 2 years to build it. Yeah. So 2 years. So you're lining people up saying, I don't need anything from you until the 2-year mark when we're going to buy it. Is that kind of how that goes?
I want to have their commitment.
You have their commitment, right? So you already have their commitment.
Yeah.
They've signed on the dotted line.
Yeah.
So in their head, they've committed, but they haven't actually fronted the money yet. Is that kind of how that works?
They'll front some of it.
Some, like a deposit.
Yeah,
against,
exactly.
Yeah.
And then, like the people that I deal with, if we've been working for a long time, I know that people know that we're serious. You know.
Yeah.
It's the same way that the builder that I work with, they can let me control 14.5 million with 20K because we're serious. Like we just bought all of these other. We just bought all of these other, all of everything that you had. So it's like, of course, you're gonna be you're not gonna be as aggressive with someone that is completely new, which is another benefit of becoming the.
Yeah.
You see, when you're an investor, you gotta fight for everything. Right?
Yeah.
Who are you? You know, but once you become the Andrew Hines, you know, then people start working with you in a very different way.
Yeah, and I just had this conversation with Jazz Takar, who's just on, and we were just talking about how, like, you know, people would take my call. Like I you know, like you said, we're in a small community, and people know, and it opens up doors, kind of being known, right? Yes. Becoming the, as you say, right?
Well, your job after getting known should be getting more known.
Getting more known, more trusted, more liked. Yeah.
And then because even if you become known, you can easily become forgotten.
Right. You got to keep ramping it up.
So you got to keep getting known. How long have you been doing your show for?
Just over 3 years.
3 years. After the first year, it should be good. Everybody knows you.
Yeah.
But if you would have just took a hiatus for a year, no one would know you. Nobody would even care. Right? You'd have to start over. One question.
Yes.
What the hell is this?
This is running away with your water bill.
You want me to sign a check for $3 million? Before this, I was gonna buy this building.
No toilets. No toilets. Not one. Is there any toilets on this whole property? The 500K is not a problem. There's only one thing. There's significant capital expenditures. Do you guys have a capital expenditure plan somewhere?